Welcome back to part 2 of our video on kickstarting that equity portfolio. The 4 things you need to know to make sure that your equity portfolio gets off to a really good start. There are 2 things that we covered in the first presentation. The first was finding a broker, and the second was how do you manage your on-the-job learning? Well, you don't want to discover that as you learn more and more about equity, you lose a lot of money in the meantime. In part 2, we're going to learn about getting market timing right, and also the decision you need to make about whether you should be buying ETFs or individual stocks or some combination of the two. Now let's talk about market timing. Now I mentioned in the last section that if you put a trade on, it's lost 10%, for example. It really matters whether that was good market timing or not. So if the market was falling by 10% over that time, then your trade wasn't great, but it probably performed in line with the rest of the market. And if the market fell 10%, it had probably been very difficult to make money at that time. Now, when people first get engaged with the equity markets, they're full of brilliant ideas and they just want to go ahead and buy. But think before you buy, is this the right time to be buying equity? However good your ideas are, if the equity market's about to tip over into a bear market, chances are most sectors are going to go down and most stocks are going to go down, and you're really giving yourself a tough time to perform. So it's really important to look at the broader context and try and get that market timing right. So if you think the market is looking rather flaky, and the consensus maybe, if you don't have a view yourself, but if the consensus is quite negative, then maybe now's not the time to dive in and actually buy real equity. Now might be the time to either sit it out to the sidelines and do something else, maybe practice in government bonds, which might be performing better at that time, or to paper trade. When you think the market is going to go up, that's when you really want to start to get involved in buying equity. Now, of course, judging market timing is really, really difficult, and I think many people say that's best left to the experts. Again, you'll have to take a view. Are you confident? Do you have the skills to be able to judge market timing? If you think the answer to that question is no, in that case, you just maybe would rather put a bit of money to work this month, a bit more money next month, and so on and so on, every month building your portfolio a little bit, because you have no sense of when the market is going to go up. And that's absolutely fine. I know a lot of people who do that because they believe market timing is one of the hardest things you can possibly forecast. There are other people, like myself, who think they have some sense of what market timing can be, and that they believe that timing is a really critical part of when you buy and sell. That's just my view. It works for me. It may not work for you. If you think that is the case, and of course you might have established your competence on this by actually looking back and saying, over the course of a few months, have I been able to spot those turning points? If you think you can, then by all means, make sure you buy just before you think the market's going to go up. But don't necessarily leave it to random. Don't let your good ideas, it's so tempting when you've got a fantastic idea. I just want to put that money to work. I want to go out there in the market and buy the stock. Don't let your emotions get carried away with you. Be very intentional about this. Either I bought because I can forecast market timing and I think now is the right time, or I bought because I buy something every month because I can't forecast market timing. But at least your decision is rational. It's not random. Don't let your emotions take control of what you're doing. And this is the last thing that I wanted to cover, which is, are you going to buy single name stocks? In other words, individual companies? Are you going to buy ETFs? Or are you going to buy funds where someone else makes the decision which stocks to purchase? Again, what works for one person doesn't work for another. And some people, like myself, they blend all three. In some areas, they might buy funds, others ETFs, and others individual stocks. So I'm going to tell you what I decided to do and why it worked for me. But of course, something quite different might work for you. But my experience will give you a sense of where you might be. So I took the view that I did want to hold some part of my portfolios in markets in Asia or in emerging markets. Now, in no part of my financial career was I ever very involved in these emerging markets, and I don't believe that I'm competent to choose the individual stocks. I don't even know which stocks are in which sectors. I haven't got time to find out, and therefore, if I want to buy one of these emerging markets, like say Brazil, the money goes in a fund. Let someone else make that decision, as they're better qualified to do so. Now, when it comes to the United States, this is where I spend a lot of time. I know the sectors very well, I know the companies well, and I think I can add value by buying the individual names. I do the research, and of course it's cheaper because I'm not paying someone else to make that decision for me. Now, that works for me because I spend a lot of time covering the US both as an economist and also as a credit strategist. So that's why I'm comfortable with that particular economy. I'm also aware that the trading costs in US equity are quite low, and therefore I can regularly change my mind if I feel uncomfortable about a stock. So I use a blend of both, depending upon how comfortable I feel about the fundamentals of a particular economy and whether my competences lie there or not. Now, I also use ETFs, and I think ETFs play a very big part in my portfolio. If I decide, for example, that I want to get involved in some of the stock markets, I just want to buy the stock market. I've taken a view on a particular country, I think that market's going up. I don't necessarily know which stocks to buy, and even if I do know which stocks to buy something representative of the market is going to be incredibly expensive. It'll involve several hundred trades, and I just don't want to get involved in that type of cost. However, you can buy ETFs which cover a particular geography or a particular industrial sector, and it's a quick and cheap way to get involved in the market. And particularly when I buy a market, for example, I think I might hold it for a couple of months. It's easy to get in with one single transaction, and I can get out again with a further transaction. I tend to focus much more on single names where I'm buying companies which I think will be core holdings for me, which I'll hold for years to come, and I've carefully crafted this portfolio, and it doesn't change that much. And it's really only in the US, as I said, that I have that expertise. So that's why I think, in terms of your trading strategy, single names have a certain place there. ETFs have a certain place for getting in and out of markets or sectors really, really quickly and cheaply. And mutual funds will also have a place. You really need to think how you're going to trade. How do you think you will make money? If you're an expert on single names, if you're an expert in understanding companies, maybe an accountant, then clearly you might spend a lot more time looking at single names than I will and buying individual stocks and shares. If, like me, your background is in economics and therefore you have a good big picture view over individual sectors or individual countries, then you might decide that mutual funds and ETFs will be a more appropriate way for you to address a particular market. It's up to you, and there's no reason why you can't change your mind at a later stage, but at least don't leave this one to accidents. Take a view before you start, based upon the skills you have, the knowledge you have, and how you intend to trade. What will work for you, that's going to be the structure of your portfolio. So thanks very much for watching. I hope that was really helpful. If it was, please click like, please click subscribe. There'll be more videos coming along very soon. If you want more details, because obviously I've covered this in a very broad brush way, if you want more details, have a look at our website. I'm putting the link up in a moment, and you'll see there's more courses that we offer which will give you much more colour in the mechanics of ETFs, trading equity, that I think will be certainly really helpful for you. But what I've done today is to share with you certainly my experiences of when I first started. Thanks for watching.